This video is brought to you by togetherbudget.com. An emergency fund is a pool of money set aside to cover unexpected expenses and maintain financial stability. It's not meant for long-term savings or investments, but rather a cushion to fall back on when life throws curveballs. Think of it as a safety net that catches you if you lose your job, need unexpected repairs, or face medical bills. Having an emergency fund in place can make all the difference during difficult times. With a safety net, you can avoid going into debt or dipping into retirement funds when unexpected expenses arise. It's also less stressful to know that you have a financial cushion to rely on. Building an emergency fund requires discipline, but it's essential for long-term financial health. Start by setting aside a small portion of your income each month and gradually increase the amount as you build momentum. Remember to keep it separate from your regular savings and investments. Don't wait until an emergency strikes before building your safety net. Procrastination can lead to financial regret and increased stress. Take control of your finances by setting up automatic transfers into your emergency fund and watching it grow over time. Life is unpredictable, and unexpected expenses can arise at any moment. A car breakdown, medical emergency, or job loss can leave you financially stranded. An emergency fund helps you weather these storms by providing a cushion of savings to fall back on. With an emergency fund in place, you'll be better equipped to handle the financial impact of unexpected events. A common mistake people make is relying on credit cards or loans to cover emergencies. These options often come with high interest rates, fees, and long repayment terms. An emergency fund offers a more sustainable solution by allowing you to pay for expenses without accumulating debt. The goal of an emergency fund is to cover 3-6 months of living expenses. This might seem daunting, but starting small and gradually increasing contributions can make it more manageable. Aim to save a portion of each paycheck or adjust your budget to allocate extra funds towards your emergency savings. Building an emergency fund requires discipline and patience. It's essential to treat your emergency savings as a non-negotiable expense alongside rent, mortgage, utilities, and groceries. By prioritizing this fund, you'll be better equipped to handle life's unexpected twists and turns. The emergency fund is designed to cover unexpected expenses, including car repairs, medical bills, and home maintenance costs. These expenses can be categorized into essential and non-essential expenses. To calculate your emergency fund amount, consider 3 to 6 months' worth of living expenses, including essential costs like rent, utilities, and food. This will ensure you can cover unexpected bills without going into debt. You can also take into account any irregular expenses that occur only once a year, such as car registration fees or property taxes. Next, assess your income stability by calculating your average monthly take-home pay. This will help you determine how much money you can realistically set aside each month for your emergency fund. Be sure to factor in any variable income or changes in your job status. Now, it's time to add up your necessary expenses and subtract them from your average monthly take-home pay. This will give you the amount of money that should be allocated towards your emergency fund each month. Finally, consider your financial goals and risk tolerance when determining the ideal size of your emergency fund. If you have a stable job or other sources of support, you may need less in your fund. On the other hand, if you're self-employed or have an irregular income, it's best to save more. A high-yield savings account is a popular choice for emergency funds because it's liquid, earns interest, and often comes with debit cards or checks. This type of account allows you to access your money when needed, while keeping it separate from your everyday spending account. Certificates of deposit, CDs, are time deposits with fixed interest rates and maturity dates. They can provide a slightly higher return than traditional savings accounts, but you'll face penalties for early withdrawal. This option works well if you can keep your emergency funds locked away for the agreed upon term. Bonds, especially short-term ones, can offer competitive interest rates without requiring you to lock your money for an extended period. Government and corporate bonds both have their pros and cons. Consider researching the issuer's creditworthiness before investing. Money market funds or accounts pool money from multiple investors to invest in low-risk, short-term debt securities. These often come with check-writing privileges and debit cards for easy access. However, be aware that these accounts may have some fees associated with them. The first step in building an emergency fund is to understand your financial goals and needs. Identify the amount of money you need to cover 3-6 months of essential expenses, including rent, mortgage, utilities, food, transportation, and minimum debt payments. Once you have determined how much you need in your emergency fund, it's time to start building it. Start by setting aside a fixed amount each month from your income and consider automating the process with direct deposits or transfers. To maintain your emergency fund, it's essential to regularly review and update your balance. Check your fund at least quarterly to ensure you're on track to meet your goals, and make adjustments as needed. In addition to building and maintaining an emergency fund, it's also important to consider other ways to reduce financial risk. This includes creating a budget, paying off high-interest debt, and investing in long-term savings vehicles. In many cases, people struggle to create an emergency fund because they have a hard time separating their regular expenses from one-time purchases. As soon as some extra money comes in, they tend to use it for discretionary spending rather than saving. This can be due to habits formed over time or the lack of clear financial goals. Another common obstacle to creating an emergency fund is the pressure of debt repayment. Some individuals might feel that they can't afford to save money when they have high-interest debts to pay off. They may put themselves in a cycle of living paycheck to paycheck, never having enough for both debt repayment and saving. Some people struggle to create an emergency fund due to their income stability. They may have variable incomes or work in industries where pay can fluctuate greatly from one month to the next. As a result, they find it difficult to establish a stable savings plan. Finally, many individuals struggle to create an emergency fund because they're unaware of their own spending habits and financial situation. They might be living beyond their means without realizing it, or simply not keeping track of their expenses. The unexpected car repair bill of $1,500 left Sarah without a safety net to fall back on. She had to take out a high-interest loan, which led her into debt and made it harder to pay off her other bills. To avoid this trap, she started building an emergency fund with small regular contributions from her paycheck. When John's employer cut back on his hours, he found himself without a steady income. His emergency fund helped him weather the storm and avoid debt by providing 3 to 6 months' worth of living expenses. Medical emergencies, like a sudden surgery or illness, can be costly and disrupt your financial stability. An emergency fund helps Sarah prioritize her medical bills over other expenses and avoid debt. After a flood damaged his home, Mark had to cover repair costs quickly. His emergency fund helped him avoid taking out an expensive loan and allowed him to focus on rebuilding without adding more debt. In building an emergency fund, it's essential to consider other financial goals, like retirement savings. By tying in your emergency fund with long-term objectives, you can create a cohesive financial plan that aligns with your values and priorities. This means allocating a portion of your income towards both short-term and long-term goals simultaneously. To effectively integrate your emergency fund with other financial goals, start by assessing your income and expenses. Create a budget that allocates sufficient funds for both short-term and long-term objectives. This might involve adjusting your spending habits or exploring ways to increase your income. Another crucial step in tying in your emergency fund with other financial goals is to prioritize needs over wants. Be honest about which expenses are truly necessary and allocate accordingly. By doing so, you can ensure that your emergency fund grows alongside your retirement savings. Finally, to truly integrate your emergency fund with other financial goals, consider automating your savings. Set up automatic transfers for both short-term and long-term objectives, ensuring that you're consistently making progress towards your goals without requiring manual effort. Identify your emergency fund goals and priorities to determine how much you need. Consider factors like income, expenses, debts, and financial obligations. Calculate a realistic target for your emergency fund based on these factors. For example, many experts recommend saving 3-6 months' worth of living expenses in an easily accessible savings account. Once you've established your emergency fund goals, open a dedicated savings account specifically for this purpose. Choose an account with minimal fees, easy access to funds, and a stable interest rate. Consider using a high-yield savings account or a money market fund to maximize returns without sacrificing liquidity. Set up automatic transfers from your primary checking or savings account to your emergency fund. This way, you'll ensure consistent deposits without having to think about it. You can also set up separate transfers for specific expenses like rent or utilities to help prioritize essential payments. Accessing your emergency fund, start by using the 50-30-20 rule. Allocate 50% of the funds for necessary expenses, 30% for discretionary spending, and 20% for debt repayment or long-term investments. Be cautious not to deplete your entire emergency fund in one go. Instead, use it as a temporary solution until you can get back on track. To review your emergency fund, gather statements for all of your savings accounts and investments to get a clear picture of your current balance. Check if you have surpassed the target amount or fallen short. If you've reached the goal, consider increasing it as inflation may erode its purchasing power over time. A key part of maintaining an effective emergency fund is rebalancing it periodically. You should reassess your goals and priorities every 6-12 months to ensure that the fund remains aligned with your changing needs. If you've experienced a significant change, such as a move or job loss, update your target amount accordingly. To rebalance your emergency fund, allocate a portion of your income towards building it up. Set aside a fixed amount each month, or use windfalls from bonuses or tax refunds to add to the fund. This will help you maintain an adequate balance without significantly impacting daily expenses. Maintaining an adequate emergency fund requires discipline but also flexibility. Be prepared to adjust your target amount in response to changes in income, expenses, or financial goals. This includes reviewing and updating the fund's allocation among different types of savings, such as checking accounts or long-term investments.